What's up, guys? It's Mr. Fit to Flourish, and today I wanted to talk about how to enter and exit trades using the patterns that we talked about. So a lot of the patterns are setups, what we call setups. So let's get right into it. All right, so when it comes to a setup is a chart pattern with one or more bars that leads the trader to believe that they can get into a trade and make profit. So beginners should usually only enter when the signal bar is in the direction of their trade. So if you think that the stock is going to go up, then that bar should be a green bar. If you think the stock is going to go down, then the bar would be a red bar that tells you to get in. A signal bar is a bar that forms that is the reason that you entered the trade, okay? And they look kind of like this. They're confirmation, all right? They're confirmation. Let's make this a little bit bigger so we can take a look at it closely. So confirmation is the idea of waiting for an event or a pattern on a chart that provides an opportunity to get into a trade. Okay, so bars like this on the right hand side, this example, it's a big bull bar closing close to its high. It's a sign of strength in buying, okay? Typically when you enter after those big bars or a signal bar, you get in one tick above that bar, and it's called a confirmation bar. A tick is a measurement of the minimum upward movement, or if you're going down, the minimum downward movement of in price of a security, okay? So again, we talked about strong bars, we talked about these patterns. But what I wanted to talk about today was not only getting in on those bars, which we'll show in a second, but also looking at key levels. So the way kind of to enter trades is usually you'll be at a key level and you'll have some strength in buying or strength in selling at that key level. And we'll talk about that. So key levels are areas of support or resistance from past price action. So they can be resistance, support, the previous day's high, the previous day's low, the previous day's close, the previous day's open, today's open, monthly averages, moving averages, monthly highs or lows. Those are key levels, okay? So they're levels that the market is going to keep testing those prices. The market's going to keep testing those prices. What does it look like? Well, this is a blank chart. And in this chart, you see that we're hitting these areas where price all of a sudden just turns around. So here, we're moving up. All of a sudden we turn around. Moving up. All of a sudden we turn around. Here, we're moving down. All of a sudden we turn around. So what's going on there? We're hitting these key levels. So you could draw a line at those levels where you see prices stopping and starting. Draw a line there because when you hit them again in the future, something big is going to happen. Keep that in mind when you're trading. Okay, key levels will transform your trading, I promise. And here's some examples of how I draw key levels. So most of these key levels are support and resistance. Resistance is the area above highs. It's one line. It's pretty much a point where stocks do not trade above, or where price action does not go above. Support would be the area where price action does not go below. And then like that, supply and demand are similar, in which supply is the high area, but it's a zone. So it's an area between 2 points as opposed to just one defined point. And the demand zone is an area between 2 points where buyers usually step in and push price back up, okay? So besides that, I wanted to show you, hey, how do we get into these trades? So last time I recorded this video, I didn't even show this tab. So I'm showing the tab now, making sure I'm showing this tab. And how did I use this to get into trades the past couple days? Okay, so let's talk about this first. Excuse me. Let's talk about this first example. All right. So in this first example, we had this key level, which is the 590.75 key level. It was resistance. Okay, so I looked at it as resistance. We hit that level and then we came down, then we went back up and tried to get to that level again. So we pretty much created a near double top. Okay, this is pretty much a double top. Now, this goes back to our setups. We talked about the double top neckline break play. So we had a double top here, we had a neckline, and not only that, but we also had the pink line going below my yellow line. The pink line is the 9 MA, yellow line is the 20 MA. A 920 crossover to the downside signifies a market structure shift, which basically just means prices were going up, now they're going to come down. Okay, this is also called the break of structure. Don't worry about it. Anyways, so we have a double top, we have our neckline, and we had a trend bar. This is my signal bar right here, this big red bar. We had a trend bar break below this neckline. Okay, so this is the neckline. Trend bar break below that neckline. Now I would want to enter on the next bar. So after this bar closes, I'm going to enter on the next bar. This would be my entry here on the next bar here. And then notice how we hold right at the close of that bar. That's called a hold level, a Wall Street hold level. And then we continued to the downside. Okay. So this is a double top neckline break in real time. Now let's go to some more examples. Okay. So we're going to talk about the Wall Street hold level on this example here. So the first thing to notice here is this is the 5-minute time frame. This is SPY. So my bad for not saying that before, but SPY on the 5-minute time frame. Again, 584.64 is a key level. I saw that in the past we hit this level and we kind of respected it. We bounced off of that key level. So again, on this day we hit that key level and it acted as support. So these key levels are really, really important when it comes to getting in to trades, getting in and out of trades. So we opened up, we actually gapped down on this day. So we gapped down, sat on top of that, like literally opened at that key level. We pushed up, came back down. These are weak bars here. These are pretty small bars, which are non-trend bars. So you don't really want to get in after these small bars. You want to get in after trend bars, which are big bars that cause a move in one direction or the other. But small bars don't cause a move in a direction, so you can't really tell where they're going. So don't get in after those bars. But we kind of went up, we went down, we went up, we went down. So we created this range here. So I usually draw what I call a consolidation box around these bars. And I don't draw it from the wick because wicks don't count. So we want to see where is price action finishing at the end of these 5-minute time frames. So where do buyers and sellers agree at the end of the 5-minute time frame, agree that price should be. So we had a low here, well, an open, and then we had a close and an open here. So around this box is my consolidation area. And this is what we talked about in terms of the opening range breakout strategy. So my signal bar would be this big green bar because this is the bar that broke out of this range. It broke outside and it closed outside of that range. Once we close outside of that range, that's what we're looking for an exit. Okay. Now, what is a Wall Street hold level? What is a hold level? So a hold level is a level at the close of a bar. So with the bull bar, it's the close of that bull bar. And what that's telling me, that level is right there. So at the close of the bull bar. And what that's telling me is if the next bar holds above that close, then we likely have enough buying pressure to continue to the upside. And the same thing goes for bear bars. So for a bear bar, like this signal bar that I talked about when we broke below this neckline, if we hold at the close of this bar, if we stay right at it, so we're staying right there, this is the hold level. If we stay here, if these bars keep closing right here, then we're likely to continue to the downside. Now, how do you know if there's going to be a reversal to the upside? Well, if you have a bear bar go down, this would be the hold level. And then a green bar pushes back up past the hold level. So we're probably going to go back to the upside. Okay, back to the upside. And then another example here would be, this is a nice bear bar. Boom, it pushes down. So we need to hold below this bar. So the bars after this bear bar, this big trend bar, the bars after this need to close below this in order for us to continue down. But notice how we create these bottom side wicks. Bottom side wicks means the buyers are stepping in. And then the next bar, this bar here, this bull bar, the next green bar, it pushed up more than 50% of this red bar, which means it's a piercing line bar, which means basically if you have a lot of selling in one direction and then at least 50% or more buying in the other direction, we're likely to continue to the upside. And the opposite is true as well. So if we had the big green bar here, and then we end up moving down more than 50% of the bar, then we're going to come down. So that's why a hold level is important, because it's important that we maintain enough pressure to keep the play moving in that direction. So for instance, here it's a green bar, we're moving up. If we hold at the close there of this signal bar, this is my signal bar because it's the bar that tells me to get in, signal bar. If we hold at that hold level, then we're likely to continue up. Some of you guys know this as a high probability fair value gap. If you watch that ICT stuff, but it's just a hold level, okay? So we held and we went. So one common thing to learn about trading is that when you get into a trade, good trades just go, okay? Good trades just go. So if it's like a bad trade, it's gonna kind of teeter around, or it's gonna fall a lot before it goes up a little bit. But good trades, if you know, the way to know you got in on a good trade is that, boom, you get in, it freaking flies, okay? It freaking flies. So good stuff there. All right, and then another example was the day before. So a lot of the same thing keeps happening. So here, again, we had the first 30 minutes of price action. We created this range here. So we went down, then we went up, then we went down, like right on this level here. So we had resistance up here, and then we had support right there. So we created this range. And then finally we had this big green bar break out of the range. Then these bars pretty much held next to the close of this bar. They didn't go more than 50% down in the opposite direction, which means there's a lot of buying pressure, a lot of strength in buyers in the market. So this would be your entry here. Your entry would be on the open of the next bar, on this red bar. And we held, and then all of a sudden we get this huge rip to the upside. The reason we got the rip is because this is a breakout. Okay, a breakout. So hopefully this helps you guys. I'm gonna do the next video. My last video was super long, but I had to re-record it so I could show you the screen here. So the next video is gonna be a part of this series as well on the chart patterns to look at, but it's gonna be more on auction market theory, which tells you how and why supply and demand works, how and why the markets move in any market, crypto, gold, futures, commodities, equities. So it'll tell you all about how charts move. Okay, so hopefully you guys enjoyed this video. It's Mr. Fit to Flourish, your boy, part 3 of the series. Like, share, subscribe if you like this stuff. I'm out. Good morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance, and growth.